Chapter number 12 of the financial playbook for Gen Z. Let's jump right in. Chapter 12, track your money. Track all of your income, track all of your spending, and track all of your account balances so that you are always aware of your finances. Awareness of your finances will help you to control and manage your finances wisely and will put you in a position to make wise financial decisions. This is key because a budget is telling your money where to go instead of wondering where it went. When you go to make a budget, it's essential that you have the full picture of your financial situation, right? Now, manage your money system, right? Manage your money system. Budgeting promotes awareness, awareness promotes control, and control encourages you to not overspend a budget, right? Budgeting is like I said, I'm going to say it one more, I'm going to say it again. I'm going to say it again because it's so important. Budgeting is telling your money where to go instead of wondering where it went. Now, I highly recommend that you do a zero-based budget for each month before the month begins. Basically, a zero-based budget is where you consider all of the cash inflows and outflows, right? And you ensure that they equate to zero. So basically, you take all your cash inflows, and then you assign all of your expected cash inflow. You assign it to an outflow, right? Even if it's and hopefully you're going to have money left over to assign to savings and investing, right? But you give every dollar a name, right? Every dollar a name, as Dave Ramsey would say, right? So this includes, income, right? Inflow, right? As well as all spending, saving, and investing, right? Let's talk about money management. So it's also essential to consider your framework of financial priorities, right? The concept of interest is essential to personal finance. What is interest? Interest is the money you must pay for borrowing money and the money you earn for lending money. The definition depends solely on if you are the borrower or the lender. Let's walk through an example. Suppose Mike takes out a car loan at 10% annual percentage rate, APR, right? The APR is the percentage of the principal that you are charged as interest each year throughout the life of the loan. Now, given that the total cost of the car is $16,000, Mike was able to put down $4,000. Okay, suppose that the total cost of the car is $16,000, and suppose that Mike puts down a down payment of $4,000. All right. And now, what is a down payment? A down payment is a chunk of money paid up front. All right. The down payment is likely the biggest single payment you'll ever make on that vehicle, right? Or on a house, right? Or whatever large purchase you're making, right? Each payment after that will become a monthly installment, right? So with Mike's down payment of $4,000, he needs to borrow $12,000 to reach the full cost of the car, which is a total cost of $16,000. Now, Mike borrowing thousands of dollars to pay for the remainder of the car is called financing, right? The portion of the car he is financing is a loan, right? Money borrowed is a purchase financed, right? Now, let's look at the situation, all right? So Mike owes $12,000 of the car that he financed, right? Or in other words, borrowed as a loan, right? So he's paying $200 a month, right? That is his monthly payments. Now let's calculate how much he will be paying towards interest and how much of that is going towards the principal, right? To accurately calculate those values, let's first define a few terms. First, what is principal? What does that term mean, principal? The principal is the amount of money owed. When you pay down the principal balance, the amount you owe, excluding interest, right? The amount you owe is getting smaller and smaller, right? The principal is the value you'd be paying if you were to make the purchase all at once without taking a loan, right? However, with big ticket items, few people can afford to do this, right? Now, interest, on the other hand, is the money made by the loan itself, right? To calculate the interest for a year, multiply the principal by the APR, the annual percentage rate. That value is the amount of interest that will accrue on your loan over the course of a year. To determine the monthly interest, simply divide that number by 12, right? Because there's 12 months in a year. Now, for Mike's situation, let's figure out his numbers. Multiply the principal, $12,000, by the APR, 10%. So that's 12,000 times 10%. That gives us $1,200. But remember, that's for the whole year. So we must divide that by 12, right? 12 months in a year, right? But divide that by 12 to find the monthly interest. So $1,200 divided by 12 comes out to $100 in monthly interest. For the first month, the amount of interest accrued, right? And accrued means grow, right? Accrued, right? Is $100, right? Now, if Mike's monthly payment is $200, then he can expect 100 of the 200 to cover the interest, while the remaining, amount will go towards reducing the principal. In this chart, we have $12,000 as the amount that's owed initially, and a monthly payment of $200. After the first month, what's the situation? Of the 200 that we pay for the first month, 100 of that 200 will go towards the interest, and the remaining portion will go towards the principal. At the end of that month, the new principal balance will be $11,900, because 100 of the 200 monthly payment was used to reduce the principal. Now, let's go through the second month. Mike pays another payment of $200, but our calculations change slightly. When we determine the distribution towards principal and interest now, it's not out of 12,000 because we reduced the principal to 11,900. When we do the calculations for the second month, we need to multiply 11,900 by 10%, and then divide by 12 to find a monthly interest of $99. For the second month, with a payment of $200, only $99 will go towards the interest, leaving $101 to go towards reducing the principal. At the end of the second month, our principal balance will be $11,799. Looking at the third month, how much is our principal, right? How much is owed, right? It's now going to be $11,799. So for the third month, Mike does another payment of $200, right? And if we do the calculation, then you take 11,799 times 10%, divide that by 12, and we get $98. So now only $98 of the $200 goes towards interest. The remaining portion, $102, goes towards paying down the principal. After the third month, the principal balance is $11,697. So do you see what's happening? With each payment, a portion of the payment is going towards the interest, and the remaining portion is going towards paying down the principal. This process is called amortization. Amortization. I know it sounds like a big term, but really it's simple to understand. Amortization is hard for me to say. Wow. Amortization. Amortization is the process in which part of each payment goes towards paying the interest, and the remaining part goes towards lowering the principal balance. Mike's car purchase is a perfect example of amortization. Here's the thing though, the payment always has to be greater than the interest, because the payment must be able to cover the interest and have excess to pay down the principal. What happens though if the payment does not cover the interest? That would be called negative amortization. That would be called negative amortization. Negative amortization is when the payment is not enough to cover the interest. If this happens, the unpaid amount of interest gets added to the principal balance. In a situation of negative amortization, your principal balance will increase rather than decrease. So if the payment is more than the interest, then the excess will decrease the principal in the process of amortization. However, if the payment is less than the interest, then the deficit will increase the principal in the process of negative amortization. Let's jump into an example. This example is about a student loan, okay? Now let's say a student loan is $37,584, okay? All right, with an APR of 5.8%. Now, given this information, what is the interest per month on that student loan? Remember to use the formula. Principal times APR times the fraction of the year, right? Because the APR is for the whole year, but we only want to calculate it for 1 month, which is a fraction of a year. So to calculate interest, we would multiply 37,584 times 5.8%, right? And so when you put it into a calculator, you're going to put it in as 0.58, right? Because 5.8%, as a decimal is 0.58, right? So and then you divide the resulting number by 12, right? And you get $182 of interest per month. Now, we just learned about amortization and negative amortization. If the interest per month is $182, that tells us our payment must be greater than $182 in order to reduce the principal balance. If the payment is less than $182, then you will never pay off the student loan, because the principal balance will stay. So if the payment is exactly $182, then the principal balance will stay the same, right? If the payment is less than $182, then the principal balance will increase because of negative amortization, right? So, it's amazing. It's amazing how this stuff works. So no one wants to pay their loan forever, right? So instead, let's say that you pay $200 per month. So month one, the interest owed is $182, but you pay $200, right? Then the excess of $18 will go towards paying down the principal. Now, $18 is a small amount. It'll take you over 40 years to pay off that student loan if you're only paying $200 per month, because there is only a small increment of excess each month to go towards paying down the principal. By the time the student loan is fully paid off, the total interest paid will be $61,511. Combined with the principal, the total cost of the student loan will be $99,095. That's essentially $61,511 of interest, right? Now, pretend your monthly payment is $300. Every month, $182 of the $300 will go towards the interest, and the excess 118 will go towards paying down the principal balance, right? So, or I guess you could say, like, yeah, well, like in the first month, 182 yeah, in the first month 182 of the 300 will go towards the interest, and the excess $118 will go towards paying down the principal balance. And so in this instance, it would take you 16.1 years to pay off the student loan, right? Your total interest would be $20,291, making the total cost, the principal plus the interest of this loan, come at $57,875. Now, better yet, let's say you can pay $500 per month. Paying off the loan would take you only 7.8 years, and your total interest would only be $9,233. That brings your total cost, principal plus interest, to $46,817. One more example. This time with a monthly payment of $750 per month. You could pay the loan off within 4.8 years if you're paying $750 per month, right? And in that situation, the total interest would only be $5,557, bringing the total cost of the loan to $43,141. So what's the key point? The key point is this. While it may sound nice to pay less per month, it will cost you thousands of dollars in the long run. Let's jump into a third sample scenario. The first two examples were examples of borrowing money, right? Interest is the money you pay for borrowing money. However, you can also earn interest by lending money. In the third example, we will look at the potential of a savings account at a bank, right? Now, different banks and types of accounts have, different terms of interest, all right? For example, there are a lot of checking accounts that don't pay interest at all, right? But there's savings accounts. There are many savings accounts that do pay interest, all right? And depending on the saving account, depending on the bank, right? There's different levels of interest, right? So you want to do your research to be able to, find a bank that pays a good interest rate on a savings account, right? Now, for the sake of this example, let's just use an APR of 2%, okay? Suppose that your savings account is paying 2%, all right? Now, side note, there are a lot, currently there are a lot of high yield savings accounts that pay over 4%, right? APR, right? But for this example, let's just use an example of 2% APR. So to keep the number simple, let's say $10,000 is the amount that you have deposited into a savings account with a 2% APR. Now, at the end of the first year, how much money will you have in that account? Well, it all goes back to the percentages, right? You multiply the principal by the APR and then by the fraction of the year. Now, in this case, we're calculating it for the whole year, right? So to figure out your earnings, you'll take 2% of 10,000. Now, since we are only interested in the annual earnings, there is nothing else to calculate, right? Because we're calculating it for the full year. So the interest for the year is $200, meaning by the end of the year, your bank account will have grown to $10,200. At the start of the second year, you will have $10,200. To determine your balance at the end of the second year, then you repeat the calculation, but you do it with the amount 10,200, right? Instead of the amount of 10,000, right? So you take 2% of 10,200, which is $204, right? Meaning your account balance will then be $10,404 by the end of the second year. At the beginning of the third year, your balance is $10,404. The interest earned throughout the year will then be $208, leaving you with a final balance of $10,612 at the end of the third year. And so then for the fourth year, the interest will be $212, right? And for the fifth year, the interest will be $216. The sixth year, the interest will be $221. Do you see how the interest is increasing? This is an example of compound interest, right? Now, keep in mind, these calculations use a low interest rate, right? In our example. In many real life examples, such as in real estate investing and in private money lending, right? The rates can be around, the APR can be more like 15%, 16%, 17%, right? In these situations, compound interest facilitates an even more impressive growth that is truly worth using to your advantage. The key point is that interest can work for you or it can work against you. The first two examples were about borrowing money. And as you saw, when you borrow money, you have to pay interest. But in the third example, when you are lending money, right? Like lending money to the bank, right? Which when you have a savings account, it's like you're lending money to the bank, right? In that situation, you are earning interest. Now let's talk about banking basics, all right? Bank accounts are important to help us to keep our finances organized. However, there can be some confusing terms associated with banking. Let's go over some of them now. What is a bank transaction? A bank transaction puts money into your accounts in what's called a deposit, right? It can also take money out of your accounts, which is called a withdrawal, right? There are two types of bank accounts: checking accounts and savings accounts. A checking account is what you will use for the majority of your transactions. It is designed for you to easily send and receive money. It comes with a checkbook, a debit card, the ability to set up direct deposits, automatic withdrawals, online banking, etc. A savings account is designed for you to store money that you don't immediately plan to spend. Let me say that again. A savings account is designed for you to store money that you don't immediately plan to spend. One of the main benefits of a savings account is that you can earn interest, right? Like there are a lot of savings accounts that are high yield savings accounts, right? Now, what is a high yield savings account? A high yield savings account is a savings account that pays relatively high interest rates compared to other savings accounts. Compared to many other investments, savings accounts pay low interest. However, it's more interest than you'll make by storing your money in a checking account, right? Now back to checking accounts. Checking accounts, now direct deposit allows your paycheck to be deposited directly into your account each payday. And so therefore you don't need like a paper check, right? When you set up direct deposit. A debit card is a useful card that's linked directly to your checking accounts, enabling you to make purchases where the amount is automatically deducted from your accounts. In contrast, when you use a credit card, the amount is charged to your line of credit, meaning you will pay the bill at a later date. Now, in general, the money you need immediately should be kept in your checking account because it's highly accessible. Money you are saving as your emergency fund or for any large purchases you plan to make, soon, or in the long run, any large purchases that you're planning to make should be kept in a high yield savings account where it will earn some interest. Money you are saving for the distant future, like let's say more than 10 years or so, right? You should invest that money into the stock market, such as index funds, right? And or real estate investments, right? Now, what is a certificate of deposit, a CD? A CD is a type of savings account that holds a fixed amount of money for a fixed amount of time, such as 6 months, 1 year, 5 years, etc. Although it typically pays higher interest than a high yield savings account, I don't recommend CDs because you cannot take the money out whenever you want, right? It's locked in for the agreed upon length of time. Now, how do you choose the bank? How do you choose the best bank for your specific financial situation? You must identify the specific types of accounts and services that you need, and then compare various banks based on those types of accounts and services. Look closely at the terms regarding their checking accounts, the terms regarding their savings accounts, the terms regarding their debit cards, the terms regarding their credit cards. Other factors to consider may include Zelle for money transfers, the ability of ATMs, the user friendliness of their mobile app, and the presence of physical bank branches near you. What are their terms regarding business accounts? That's another question to ask, right? This could include bank accounts, business debit cards, and business credit cards. What is their customer service like? Look at all these different things as you're comparing various banks to help identify the bank that is the best fit for you. Now, compare the minimum balance requirements that will allow you to avoid any monthly maintenance fees, right? Compare the fees for special services, such as sending and receiving wire transfers. Compare interest rates that you can learn, compare the interest rates that you can earn on high yield savings accounts. Compare the credit card rewards that they offer, right? Here's the key point. Different banks have different strengths, and it's up to you to research to find the best fit for you. All right, and think about it, Now, here's a quick question. A quick quiz, I guess. What is the main advantage of a checking account, right? What is the main advantage of a checking account? One of the main advantages is the flexibility and ease of money transfers. It's easier to access money in a checking account compared to a savings account. Checking accounts are designed for high volume of activities, such as sending and receiving money. Now, what is one of the disadvantages of a checking account? Well, typically, checking accounts do not pay interest or only pay interest at an extremely low rate. Now, question, what is the main advantage of a savings account? Well, typically, you earn interest on the money in a savings account. Now, what is a disadvantage, though, of a savings account? Well, in savings accounts, your money is not as flexible or accessible, right? Typically, for example, you cannot write checks withdrawing from a savings account, right? Now, sometimes banks even have a limit to the number of transactions moving money in and out of a savings account, right? Now, why is it important to check your bank transactions and balances on a routine basis? Well, first, you always want to be aware of how much money you have, to avoid dropping below your minimum balance, right? So, because that way you can avoid bank fees. You also want to be able to identify fraudulent activity within your accounts. If you recognize a transaction that you did not make, you must quickly report it. This requires ongoing awareness of your balance and transactions. Now let's talk about budgeting. What is budgeting? Budgeting is telling your money where to go instead of wondering where it went. In other words, budgeting is like assigning your employees to specific jobs based on your financial priorities. Every dollar is like an employee. With a team of employees, you must decide how you're going to assign each person a specific job based on your priorities, right? The same applies to your time. Every hour is like an employee. The ultimate goal of budgeting is awareness that builds control. By tracking every dollar, as well as tracking every hour, right? You will automatically build an appreciation and you will build an understanding for how to manage your money and your time wisely. Let's talk about priorities. To build an effective budget, you need to clearly define your financial priorities. These will be different depending on the person, but because everyone is in a different financial situation. However, I'd like to give you an overview of financial priorities for you to consider. I call this the framework of financial priorities. Number one is tithe, right? Give money away. I believe that it's so important to prioritize tithing, giving a portion of your money to your church or to a good cause, or to someone that is in need, right? When you give with a sincere heart of gratitude, you confirm to yourself that you have more than enough. And that sense of abundance enables you to live a truly healthy life with more gratitude and empowerment. Giving will ultimately enable you to earn more money because of the confidence that it instills, the energy that it instills within you, right? Build, so giving is very important. Number two, build a $1,000 mini emergency fund, right? Now, a fully funded emergency fund contains 3 to 6 months of your living expenses, right? However, if you don't have at least $1,000 saved, you should start by saving for this mini emergency fund, right? Now, many Americans don't even have this saved, right? And it could not afford a $1,000 emergency. So if you don't already have this mini fund of at least $1,000, you should prioritize saving $1,000 as a mini emergency fund, right? Now, next thing, pay off all high interest debt. High interest debt has an interest rate. So when I say high interest debt, I mean any debt that has an interest rate above 8%, right? That's a high interest, right? Now, prioritize getting rid of all debt that is high interest. And eventually, you'll be in a place to become completely debt-free. But like I said, you need to start with baby steps. Focus on paying off all high interest debt first, and then you can move forward in attacking other debt. Now, next thing, employer-sponsored retirement fund, right? If you work a 9-to-5 job that offers a 401k or a TSP or something similar, take advantage of it if they are doing a matching, right? A matching, if they're matching contributions, because that's like free money, right? So if they're matching contributions, take advantage of it because it's free money, right? Now take advantage of it, but only up to the maximum employer match. Don't invest any more than what they're willing to match you, because the real benefit of those accounts, those employer-sponsored accounts, is the free money from the employer match, right? So the match may be up to 3% or even 5%, or some companies might even do a match, even more, but only participate up to the match. Because now some companies don't match at all, right? Now, if they don't match at all, then don't participate at all, right? Because there are better ways to invest your money, right? Because a lot of those employer-sponsored retirement funds, there's fees involved, So if they're not matching you, then most likely there's better vehicles to put your money in, right? Like a Roth IRA, you know. But if your employer does have a sponsored retirement, fund in which which they will match your contribution, then make sure you take full advantage of that match. Now, next thing is expand your emergency fund to cover 6 months of your living expenses, right? You need at least 6 months of your living expenses saved in cash, right? And it's my preference, is to put it into a high yield savings account, right? Because that way, you'll make more interest than a regular savings account. And then next thing, save for special purchases. Save up. Start early to save up to pay for things in cash, right? Like you're going if you know that you're going to need to buy a car at some point in the future, then start early to prepare for that, right? So next thing is auto invest in a Roth IRA stock index fund. The best thing you can do for your investments is to start early. So research Roth IRAs, especially the ones that are index fund. So especially look into, putting index funds into your Roth IRA, right? Because index funds attract, index funds attract a market index, right? So like the S&P 500 index is a popular index that some index funds track, So basically they are mutual funds that are highly diversified, low cost, and without many fees associated with them, right? So, and the interest is high, right? Now, despite fluctuations in returns, values historically go up, right? Like the S&P 500, right? Like the stock market, the S&P 500 represents the stocks of the largest 500 companies in the United States, right? And, when you look at that, it's like the historical average, even though it goes up and down, the historical average is over 10%, Next thing is auto invest in a non-retirement stock index fund. And, non-retirement investments are just as important as retirement accounts, right? Because you don't want to access your retirement funds until you're retired, right? However, even when you're not investing for retirement, you still want to consider index funds as long-term investments, right? Consider these funds to be money that you don't plan to withdraw within the next 5 to 10 years, When you do take the money out, there will be no penalties. So if it's a non-retirement account, you can take money out with no penalties. Now, a little side note though, even in the Roth IRA, right? You can, so with one of the benefits of the Roth IRA is that you can take out your contributions with no penalty. All right. So that's a really cool little benefit regarding the Roth IRA, So definitely look into Roth IRAs. Now, next thing is build multiple streams of income through entrepreneurship. Having one stream of income is too close to having no income, right? A great way to build multiple streams of income is through entrepreneurship. Every hobby is a potential stream of income, right? Every hobby is a potential business. So consider the things that you're passionate about and brainstorm how to transform those hobbies into businesses. Turn your passions into profits, right? And even better is having multiple streams of passive income through avenues like business ownership, stock market investing, and real estate investing. Passive income is amazing because once you put in the work up front, there's little additional work other than tracking and managing the stream. Now let's talk about the budget. Each month, I recommend constructing a written budget. Remember, awareness builds control. Now I call this method the zero-based budget. On a piece of paper or on a spreadsheet, draw 3 columns. You'll label the first 2 So label the first column expected, the second column actual, right? In the first column, list your income streams, right? And write your expected income for each, and write your expected income for each income stream for that month, right? In the second column, list your outflow, right? All of your expenses, and also all of your planned investments and all of your planned savings, right? And any money you anticipate leaving, so basically any money you anticipate as an outflow, right? So this may include the tide, right? The money that you want to give away during the month. Also, your housing expenses, your rent, your mortgage payment, utilities, internet, cell phone, groceries, eating out, public transportation, gas, car repairs, maintenance, car insurance, health insurance, debt repayments, gifts, shopping, entertainment, vacations, personal care, investing, and saving. You may have more categories, right? But so you can personalize, your budget in whatever way works best for you. Now, once all income and outflow is listed with numbers, subtract the second column, right, the outflow, from the first column, the income, and write the total in the third column, right? Your total income minus your total outflows should equal 0, because you want to allocate all of your expected income into the different outflow categories. So the goal of the budget is giving every dollar a name. In other words, you want to assign each employee a specific job and think of each dollar as an employee. So adjust your numbers accordingly until they equal 0. Now, most people find it easier to adjust their outflow, but if it's feasible to adjust your income, that's another strategy. At the beginning of each month, go through this process, write it out. Throughout the month, track every dollar of your income and your outflow, right? At the end of the month, you will be able to put in the actual numbers and compare your expected budget to your actual numbers and revise and repeat your budget. Now, another popular and effective budgeting method is the envelope system. The principle behind this is that people are generally more reluctant to spend physical cash as opposed to swiping a credit or debit card. So by splitting up your cash bills into envelopes, clear boundaries are set regarding how much you can spend on a certain category in a week or a month. So take, for example, a $400 monthly budget budget for food, right? So let's say you go to the grocery store once per week. So to effectively use the cash envelope system, all you need to do is divide $400 between the 4 envelopes, $100 per envelope, right? And use only one envelope with each grocery store visit. It's that simple. Now let's talk about credit cards. In this section, we're talking about credit cards. For the average adult, credit cards can either become a blessing in your life or a poison, right? Depending on how you handle them. We're going to discuss what credit cards are, how they work, and how you can use them to your advantage, right? Let's jump right in. First, what is a credit card? A credit card is a thin, rectangular piece of plastic or metal issued by a bank or financial services company that allows cardholders to borrow money, right, to pay for goods and services under the agreement that they will pay back the money by a predetermined date. Now, here's the trick that credit card companies play on people. The credit card company gives you the option of paying just a small portion of the monthly bill, right? And it's called the minimum balance or the minimum payments. It's called the minimum payments. My bad. It's called the minimum payments. However, this is a trap because they will charge you interest on the remaining balance, right? Therefore, you should always pay the full amount of the monthly bill to avoid paying interest. In addition to paying the full amount each month, it is essential to always pay the bill on time. The number one factor that impacts your credit score is payment history. A single late payment could cause your score to drop dramatically, especially as a new car holder. So be sure to always pay your bills on time. Here's a tip: set up auto pay. Almost all credit card companies have this option. So the full amount of your monthly bill is paid from your bank account automatically. You know, at the very least, set up auto pay for the minimum monthly payments, right? That way you will avoid ever having a late payment, right? Now, if you choose to do this, make sure you still pay your bill. Try to pay your bill in full each month, right? Now, when dealing with credit cards, closely monitor your credit utilization. What is credit utilization? Credit utilization is the percentage of credit you're using when compared to the total amount of credit you were granted by the card company, right? So when you open up a credit card, you receive a credit limit, which is the maximum amount of money you can borrow on that card. For example, many student credit cards have an initial limit of $500. This means the most you could borrow is $500, right? The most you could charge on your card is $500. However, you never want to spend the maximum allotted on a credit card, right? Always try to keep your credit utilization under, you really should keep it under 10%. But if that's very hard to do, at the very least, keep it under 30%, right? Right? You know, keep it under 30%. But really what's better is to try to keep it under 10%. Now, looking at the student card example, 30% utilization of a $500 limit would equate to spending a maximum of $150 each month, right? Now, to bring the credit utilization down to 10%, which should be your goal, you need to make your maximum limit to be $50 each month, right? You know, because, you know, or I say you should make your maximum, you know, spending limit on the card to be $50 per month, right? So that your credit utilization is 10%, right? Because it'd be 10% of the 500, right? And this will help you to maintain an excellent credit score. Now, the lower, the better. If you want to be a real superstar, right, then try to maintain a credit utilization to be under 3%, right? But if you can't do that, then try to really try to aim to keep it under 10%, right? And if you can't do that, I mean, at the very least, try to keep it under 30%. Now, if your credit limit is low, request a credit limit increase. The reporting date is the monthly date on which the credit card reports your account balance to the 3 major credit reporting agencies: Experian, Equifax, and TransUnion. Mark that date on your calendar. And each month, your goal should be to keep your credit utilization as low as possible while still using the credit card. It is important to use your card for at least a small number of transactions because this allows you to pay off your bill by the payment due dates, right? With many credit cards, the reporting date is the last date of the billing cycle. The reporting date is the date when your credit utilization will be documented. It's important to be aware of the dates because when that credit reporting date comes around, you want to make sure that your credit utilization is as low as possible, but above zero though, you know? Now, frankly, your credit balance doesn't matter during the other days of the month, as long as you know that you can pay the balance when it comes time, right? The most important thing is to make sure the credit utilization is under your goal percentage by that date, but ideally, but definitely above zero though, right? So keep your utilization above zero to avoid looking as though you're not using any credit at all, right? Not using any of the credit you were granted also has the potential to lower your score, right? So there's a fine balance between using credit while ensuring that your credit utilization is super, super low. And that's the game, that's all this financial and credit score game is really about, right? You must learn how to play the game. So let me stress it one more time. Know your reporting dates. Each month, your goal should be to get your credit utilization to be as low as possible, but above zero by the reporting date, and to pay off your bill to zero by the payment due dates, right? Now, here's another tip for the future. As you maintain an excellent credit score, help your kids to build their credit. Parents can help their kids, and even uncles and aunts can help their nephews and nieces, right? To do this, right? It's not just parents, but parents can help their kids build an excellent credit score by adding them as authorized users onto one of their credit cards. Doing this will allow the parent's credit card and payment history to appear on their child's credit report, which will enable them to piggyback on the parent's good credit history and good credit score. However, keep in mind, if you decide to do this strategy, that the minimum age requirement for authorized users varies among credit card companies. Some credit card companies, the minimum age for authorized users might be 13 years old, and others might be 16 years old, right? So remember to choose a credit card that reports authorized user status to all three of the major credit reporting agencies: Experian, Equifax, and TransUnion. Now, chapter summary. Awareness of your finances will help you to control and manage your finances wisely, and will put you in a position to make wise financial decisions. Action items. Create a monthly budget, either on paper or on a spreadsheet. Discussion question. What are your budget numbers? Quiz question. Quiz questions. Number one, why is a budget important? And number two, what is the envelope system and how does it work?